Hi, today I want to talk about the various taxes you may have to pay when buying or selling a residential property and how these taxes can impact your overall financial situation. The first decision you need to make is at the time of purchase. Should the property be purchased in your name, a family trust, or a self-managed super fund? This is important because the impact of some taxes will depend on which entity owns the property. Irrespective of the ownership structure, stamp duty will apply on the purchase. Stamp duty is a state-based tax, so the rate varies depending on where the property is located. There are specific rules in each state. For example, in New South Wales, it is imperative to ensure any trust or self-managed super fund has stamp duty paid on the deed establishing that entity to effectively allow it to operate in that state. Don't forget, stamp duty is also payable on the property purchase. You need to seek advice if buying interstate property. In Victoria, stamp duty is payable on a sliding scale. The maximum rate is 6% of the purchase price. Buying new developments off the plan offers some advantage, as stamp duty is only levied on the value of the real estate at the time of purchase, so this can offer big savings. Stamp duty concessions are also available to first-home buyers and for those on government pensions at the time the contract is entered into. Once you have taken ownership of a property, ongoing rates and taxes come into play. All properties are subject to local government rates. If the property is your principal residence, i.e. you live in it, no land tax is applicable. If, however, the property is rented to a tenant, it will be subject to land tax. Land tax is assessed on the value of the land, not the total value of the property. Again, in Victoria there is a sliding scale of land tax. Our team can help you work out what you may need to pay in your particular circumstances. If the property is owned by a family trust, there is also a surcharge on the land tax rate. Another time you need to consider tax implications is when you sell a property. If you have always lived in the property as your principal residence and the property is sold, no further tax is applicable. If, however, the property has been rented and it is sold for a profit, capital gains tax will generally apply to the sale. Capital gains tax is payable at your marginal rate of tax on 50% of the gain on the basis you held the property for more than 12 months. For example, if you sold a property in 2015 for $800,000, which you purchased in 1990 for $250,000, the profit on sale is therefore $550,000. 50% of this is $275,000, and this is subject to tax at your marginal rate. What about a holiday house? A holiday house is not your principal residence and would therefore be subject to land tax. Capital gains tax is also applicable on any profit from the eventual sale. An exemption to this is if you purchased the property prior to the 19th of September 1985, when capital gains tax was first introduced. If you change the way you use the same property over time, living in it at one stage of life and renting it out in another, tax planning becomes more important. In parts 2, 3 and 4 of this video series, I'll give 3 specific examples. Part 2, mixed use of a property for living and rental. Part 3, inheriting a property. And Part 4, selling the family home in the transition to aged care.